Every year, millions of people enter the world of investing with hope. They want freedom, security, and a better future. Most believe success comes from secret tips, fast moves, or expert opinions. Very few are warned about the silent mistakes that slowly destroy wealth. Investing rarely fails because of lack of intelligence. It fails because of human behavior: fear, greed, impatience, and imitation. People do not lose money because markets are evil. They lose money because they react instead of thinking. This book is about awareness, not prediction. It is about understanding what to avoid before learning what to do. Small mistakes repeated over time become big losses. Simple discipline repeated over time becomes lasting wealth. You will hear familiar situations, moments where everyone seems confident, times when excitement feels like safety. That is where danger often hides. The first mistake most investors make is believing the crowd knows best, and that is where our journey begins. Chapter 1. The mistake of following the crowd. Imagine standing in a long line outside a shop. You do not know what is being sold, but the line is long and growing. People look excited and confident. Without asking questions, you feel the urge to join. If so many people are here, it must be good. This feeling is deeply human. We are social creatures. For most of history, following the group meant survival. Being alone meant danger. Our brains are still wired for that ancient world. But financial markets are not forests or villages. What kept us safe then can hurt us now. In investing, the crowd often moves together. When prices rise, people talk about easy money. Friends share success stories. News headlines sound optimistic. Social media celebrates winners. The fear of missing out becomes powerful. Doing nothing starts to feel like a mistake. So people buy not because they understand. They buy because others are buying. This is how bubbles are born. Not from logic, but from imitation. At first, the crowd feels smart. Early gains create confidence. Confidence turns into certainty. Certainty turns into arrogance. Risk is ignored. Warnings are dismissed. Anyone who disagrees is called negative or outdated. History repeats this pattern again and again. Tulip bulbs in old Europe. Internet companies without profits. Housing prices that could never fall. Each time the story sounded new. Each time the ending was the same. Warren Buffett warned about this behavior with simple words. Be fearful when others are greedy, and greedy when others are fearful. This is not clever language. It is psychological truth. Greed spreads faster in groups. Fear does too. The crowd buys when things feel safe. But safety is highest when prices are low, and fear is high. The crowd sells when pain becomes unbearable. But opportunity is often hiding in that pain. Following the crowd also removes responsibility. If everyone is wrong, no one feels guilty. Loss feels lighter when it is shared. This emotional comfort is expensive. Markets do not reward comfort. They reward discipline and independent thought. Another danger of crowd behavior is noise. The more people involved, the louder opinions become. Strong voices drown out quiet facts. Short-term results replace long-term thinking. Price replaces value. Benjamin Graham explained that markets are voting machines in the short term. Popularity decides prices for a while, but in the long term, markets become weighing machines. Reality always returns. Earnings matter. Cash flow matters. Business quality matters. The crowd rarely studies these things deeply. Study takes time and effort. Excitement is easier. Stories are easier. Trends are easier. When everyone agrees, something feels obvious. But obvious ideas are usually fully priced. Great opportunities often look uncomfortable. They require patience and emotional strength. Independent thinking does not mean being stubborn. It means asking questions. Why am I buying this? Do I understand the business? Would I still own it if no one talked about it? What could go wrong? Standing apart feels lonely at first. You may doubt yourself. You may feel slow while others celebrate. But investing is not a race. It is a test of endurance. The most successful investors learned to sit quietly. They waited while others rushed. They studied while others followed. They accepted temporary discomfort to gain long-term reward. Following the crowd is often the first mistake investors make. Because it feels natural. Because it feels safe. Because everyone else is doing it. But once you learn to see this trap, you gain clarity. You realize that the crowd is emotional, not rational. You realize that popularity and value are not the same. You realize that your biggest enemy is not the market. It is your need to belong. Understanding this mistake opens the door to deeper awareness. Because once you stop following others blindly, you must face yourself. And that leads directly to the next danger. When investors stop copying the crowd, many swing to the opposite extreme. They chase excitement. They seek quick wins. They treat investing like a game of chance. That is where the next mistake begins. Confusing investing with gambling. Chapter 2. Confusing investing with gambling. After stepping away from the crowd, many investors feel free. They no longer copy everyone else. They want to be bold and decisive. This is where a new trap appears. Instead of following the crowd, they begin chasing excitement. Fast profits feel powerful. Quick decisions feel intelligent. Winning feels like proof of skill. This is how investing slowly turns into gambling. Gambling is built on hope. Investing is built on understanding. But in the moment, they can feel the same. A gamble offers instant feedback. You win or lose quickly. Your heart races. Your emotions rise. Your brain releases excitement. Many modern markets are designed to trigger this feeling. Price charts move every second. Apps send alerts. News flashes breaking stories. Everything pushes you to act now. When action becomes constant, thinking disappears. People begin to trade stories instead of businesses. They buy because something is trending. They sell because something feels scary. They mistake motion for progress. Benjamin Graham warned about this long ago. He said that speculation is most dangerous when it looks easiest. When money feels easy, risk is usually hidden. Gambling focuses on outcomes. Investing focuses on process. A good process can have bad short-term results. A bad process can have lucky wins. This is where many people get confused. They win once or twice. They believe they are skilled. They increase risk. They ignore safety. Luck feels exactly like intelligence in the beginning. But luck does not repeat reliably. Real investing asks different questions. What is the business earning? Is cash flow stable? Is management honest? Is the price reasonable? Gambling asks only one question. Will this go up soon? The shorter the time horizon, the closer investing moves toward gambling. Short-term price movement is mostly noise. Long-term results reflect reality. Charlie Munger explained this clearly. He said that people who mix gambling and investing end up with neither discipline nor peace of mind. Another sign of gambling behavior is constant activity. Buying and selling feels productive. Doing nothing feels lazy. But inactivity is often a sign of confidence. Great investors spend more time waiting than acting. They wait for clarity. They wait for value. They wait for margin of safety. Gamblers cannot wait. Waiting feels painful. Silence feels uncomfortable. They need action to feel alive. Markets punish this need over time. Gambling also ignores downside. It focuses on what could be gained. Investing always asks what could be lost. Howard Marks reminds investors that risk is not what you see. Risk is what happens when things go wrong. Gamblers assume they will be right. Investors assume they could be wrong. That assumption changes everything. Another danger is emotional attachment. Gamblers fall in love with bets. They defend bad decisions. They double down to avoid admitting mistakes. Investors treat decisions like tools. If something is broken, they replace it. There is no ego involved. Markets do not reward pride. They reward humility. Many people say they are investing, but their behavior says otherwise. They panic on drops. They celebrate short-term wins loudly. They feel stress instead of confidence. Stress is a signal. It often means risk is misunderstood. True investing creates calm over time. Not excitement. Not adrenaline. Calm. This calm does not come from certainty. It comes from preparation, from understanding what you own, from accepting that short-term outcomes are unpredictable. When investing feels boring, you are usually doing it right, but boredom is hard to sell. Excitement sells easily. That is why gambling behavior spreads so fast. Learning to separate investing from gambling is a major turning point. It shifts focus from winning today to surviving forever. Once this lesson is understood, another temptation appears. If investing is not gambling and not following the crowd, then maybe success comes from perfect timing. Buying at the lowest point, selling at the highest point. This idea sounds logical. It feels precise, it feels controllable. And that belief leads directly to the next mistake: trying to time the market. Chapter 3. Trying to time the market. After investors stop following the crowd and stop gambling, many believe they have discovered a smarter path. They think success comes from precision, from buying at the perfect moment, from selling at exactly the right time. This idea feels logical. If you buy low and sell high, you win. The problem is that knowing when low and high occur is almost impossible. Market timing promises control. Humans love control. Uncertainty makes us uncomfortable. Timing feels like a solution to uncertainty. So investors watch charts closely. They study patterns. They wait for signals. They listen to predictions. They believe the next move can be known. The market quietly disagrees. Markets move because of millions of decisions. Each decision is influenced by emotion, information, and expectation. No single model can capture this complexity. No human can predict it consistently. Even professionals fail at this task. They have teams, data, and experience. Yet their predictions are often wrong. Peter Lynch warned investors clearly. He said that far more money has been lost preparing for corrections than lost in the corrections themselves. Timing requires two perfect decisions: when to get out and when to get back in. Missing either one can destroy long-term results. Many investors sell after prices fall. They wait for clarity. Clarity never arrives. Prices rise while they wait. Fear keeps them out. Regret keeps them frozen. Others wait for the perfect entry. They believe prices will fall more. When prices rise, they hesitate. When prices fall, they panic. The perfect moment exists only in hindsight. Charts make timing look easy. Past data is clean and clear. Future data is messy and uncertain. This creates false confidence. Another problem with timing is emotional damage. Constant decision-making creates stress. Stress reduces judgment. Poor judgment leads to mistakes. Long-term investing reduces decisions. Market timing multiplies them. Warren Buffett said that the stock market is designed to transfer money from the impatient to the patient. Impatience often disguises itself as timing skill. Market timers are always alert, always watching, always worried. Investors with long horizons sleep better. They accept that short-term movements are unpredictable. They focus on long-term growth. Timing also assumes markets are inefficient. Sometimes they are. But inefficiency is unpredictable, and it does not last. Trying to exploit it repeatedly is dangerous. Another hidden cost of timing is missed compounding. Time in the market matters more than timing the market. Missing a few strong days can erase years of progress. Markets often rise suddenly. They fall slowly and recover quickly. Those waiting for safety often miss recovery. This creates a cycle of regret. Sell too late. Buy too late. Over time, confidence erodes. Doubt grows. The investor begins to distrust their own judgment. Great investors accept uncertainty. They do not try to eliminate it. They design strategies that survive it. Instead of asking where the market will go next, they ask whether the investment makes sense over many years. Instead of predicting, they prepare. Preparation focuses on quality, on balance sheets, on cash flow, on resilience. Timing focuses on price alone. Price without context is noise. Benjamin Graham taught that the market is there to serve you, not instruct you. Prices offer opportunities. They do not give orders. Long-term investors respond calmly. They do not chase. They do not flee. They rebalance when needed. They stay consistent. Trying to time the market often comes from overconfidence. People believe intelligence can beat randomness. Sometimes it can. Often it cannot. Humility is a powerful investment tool. Accepting what you cannot control frees you to focus on what you can. Savings rate, diversification, costs, time. These boring factors matter more than clever predictions. When investors stop trying to time the market, they often feel relief. The pressure to be right disappears. The need to predict fades. But another mistake waits quietly. If timing does not work, if patience is required. Some investors assume risk no longer matters. They believe time alone will fix everything. They ignore danger. They chase returns without protection. That false sense of safety leads to the next mistake. Ignoring risk and safety. Chapter 4. Ignoring risk and safety. After investors stop chasing the crowd, after they stop gambling, after they stop trying to time the market, many feel confident at last. They believe time is on their side. They believe patience solves everything. This belief can be dangerous. Time helps only when risk is controlled. Many investors focus only on returns. They ask how much they can make. They forget to ask how much they can lose. Risk is uncomfortable to think about. It ruins exciting stories. It slows decisions, so it is often ignored. But risk never disappears. It waits quietly. Risk is not just price movement. Price movement is visible. Real risk is hidden. Risk is permanent loss. Loss of capital. Loss of opportunity. Loss of confidence. A temporary fall can recover. A permanent loss cannot. Howard Marks explained this clearly. He said that risk is what happens when things do not go according to plan. Most investors assume their plan will work. They imagine best outcomes. They downplay worst cases. This optimism feels natural. It also creates blind spots. Ignoring risk often starts with stories. A company has a great future. An industry is growing fast. Technology is changing the world. These stories may be true, but truth does not eliminate risk. Even great businesses can be bad investments at the wrong price. Even strong industries face cycles. Even brilliant managers make mistakes. When investors ignore risk, they overpay, they overconcentrate, they underestimate uncertainty. Benjamin Graham taught the concept of margin of safety. It means leaving room for error. It means accepting that you can be wrong. Buying with no margin of safety is like driving fast with no brakes. Many investors believe diversification alone removes risk. Diversification helps, but it does not replace judgment. Owning many risky assets does not create safety. It spreads danger. Another common error is mistaking familiarity for safety. People trust what they know. They trust brands they use. They trust companies they see daily. Familiarity creates comfort. Comfort reduces caution. But markets do not care about comfort. Another form of ignored risk is leverage. Borrowed money magnifies outcomes. It magnifies gains. It magnifies losses. Leverage removes time. It forces decisions. It turns small mistakes into disasters. Many fortunes have been destroyed not by bad ideas, but by too much leverage. Risk also comes from ignorance. Owning something you do not understand is risky. Relying on others without verification is risky. Warren Buffett said, "Risk comes from not knowing what you are doing." Understanding reduces risk, it does not eliminate it. Smart investors assume surprises will happen. They build portfolios that survive surprises. They ask difficult questions before investing. What happens in a recession? What happens if growth slows? What happens if competition increases? They imagine negative scenarios, not to be pessimistic, but to be prepared. Ignoring risk often feels good in rising markets. Prices go up. Warnings seem unnecessary. Caution feels outdated. This is when risk is highest. Markets are most dangerous when they feel safest. Eventually, reality interrupts optimism. Earnings disappoint. Debt becomes heavy. Trends reverse. Those who ignored risk feel shock. Those who respected risk feel prepared. Risk management is not about avoiding loss entirely. Loss is part of investing. Risk management is about surviving loss. Survival keeps you in the game. Staying in the game allows compounding to work. The goal is not maximum return. The goal is sustainable return. Once investors understand risk, they often swing too far in the other direction. They become cautious. They protect capital. They avoid danger. But protection alone does not build wealth. Another mistake appears quietly: to feel safe. Some investors put everything into a single idea they trust deeply. One company, one sector, one belief. They believe conviction replaces diversification. That belief leads directly to the next mistake: putting all money in one idea. Chapter 5. Putting all money in one idea. After investors learn to respect risk and safety, they often search for strength. They want certainty. They want something they can fully believe in. When they find a strong idea, a great company, a powerful trend, a story that makes sense, conviction grows. Conviction feels like clarity. Clarity feels like confidence. This is where another mistake quietly forms. Instead of balancing belief with caution, some investors place everything into one idea. They concentrate not because of analysis, but because of emotion. They say things like, "This is different. This time I am sure. I understand this better than anything else." At first, concentration feels brave. It feels intelligent. It feels decisive. But markets do not reward bravery alone. No matter how strong an idea looks, the future always contains surprise. Competition changes. Technology shifts. Regulation appears. Management makes mistakes. Even great businesses face bad periods. John Templeton offered a simple warning: the only investors who should not diversify are those who are right all the time. No one is right all the time. Putting all money in one idea increases emotional pressure. Every price move feels personal. Every headline feels threatening. Objectivity slowly disappears. The investor begins to defend the idea. They ignore warning signs. They explain away problems. They attack critics. What began as analysis becomes attachment. Attachment is dangerous in investing. When too much depends on one outcome, fear increases. Fear leads to bad decisions. A small problem feels like disaster. A temporary drop feels unbearable. Instead of thinking clearly, the investor reacts emotionally. Another danger of concentration is overconfidence. Past success creates belief in personal skill. The investor attributes gains to intelligence. They forget luck played a role. This false confidence encourages even more risk. History is filled with stories of concentrated bets gone wrong. Great companies that failed. Strong industries that declined. Leaders who lost relevance. No idea is immune to change. Diversification exists for a reason. Not to reduce intelligence, but to reduce fragility. Diversification is not about owning everything. It is about avoiding catastrophe. Owning several good ideas protects against being wrong, because being wrong is part of investing. Some investors misunderstand diversification. They believe it limits upside. They focus on what they might miss. They ignore what diversification prevents: permanent loss, emotional ruin, forced selling. True diversification is thoughtful. It spreads risk across businesses, sectors, and time. It allows patience to work. Another mistake is confusing familiarity with safety. People invest heavily in what they know: their employer, their industry, their country. Familiar does not mean safe. In fact, it can increase risk, because problems tend to appear together. Concentration also reduces flexibility. If everything is in one place, there is nowhere to move, no room to adjust. Flexibility is power. Great investors think in probabilities, not certainties. They prepare for being wrong. They build portfolios that survive mistakes. Warren Buffett is often quoted as supporting concentration, but this advice is misunderstood. He concentrated after decades of experience, with deep understanding, with massive margins of safety. Most investors lack these advantages. For most people, diversification is wisdom, not weakness. Another hidden cost of concentration is lost opportunity. While all attention is focused on one idea, other opportunities are ignored. Markets are full of possibilities. Putting everything in one place closes doors. Concentration also creates stress. Stress reduces long-term performance. Investing should build freedom, not anxiety. This does not mean conviction is wrong. Conviction matters, but conviction must be balanced with humility. The goal is not to be right on one idea. The goal is to succeed over time. Diversification allows time to work. It allows compounding to continue, even when one idea struggles. When investors accept this truth, they begin to see investing differently. They stop searching for the single perfect answer. They start building resilient systems. But even with diversification, even with safety, even with patience, another enemy remains. An enemy that lives inside the mind. An enemy that affects every decision. Emotions, fear, greed, pride. No portfolio is safe if emotions are uncontrolled. That leads directly to the next mistake. Letting emotions control decisions. Chapter 6. Letting emotions control decisions. After investors learn about diversification and balance, they often believe the hardest work is done. They think structure alone will protect them. But structure fails when emotions take control. Emotions are always present. They do not disappear with knowledge. They wait quietly for the right moment. Fear and greed are the strongest forces in investing. They influence decisions more than logic. They feel real and urgent. They demand action. Fear appears during uncertainty. Prices fall. News turns negative. Experts sound worried. The future feels unclear. In these moments, fear whispers, "Get out now. Protect yourself. Do something." Greed appears during success. Prices rise. Profits grow. Stories sound exciting. Confidence turns into excitement. Greed whispers, "Buy more. Take more risk. Do not miss this." Both voices are convincing. Most investors believe they act rationally. But behavior tells a different story. They sell after losses. They buy after gains. This is the opposite of intelligent investing. Daniel Kahneman showed that humans feel losses more strongly than gains. Pain is stronger than pleasure. This makes fear powerful during market declines. People do not fear losing money. They fear regret. They fear being wrong. They fear looking foolish. Fear pushes investors to sell at the worst time, often near market bottoms. Greed works differently. It builds slowly. It feels like confidence. It feels justified. Investors believe they deserve gains. They believe success will continue. They ignore warning signs. Charlie Munger said that envy and greed are deadly sins in investing. They distort judgment quietly. Another emotion that causes damage is pride. Pride resists admitting mistakes. It defends bad decisions. It delays necessary action. Investors hold losing positions to avoid admitting error. They say it will come back. Sometimes it does. Often it does not. Hope replaces analysis. Hope is not a strategy. Emotions also affect how information is processed. People seek opinions that agree with them. They ignore opposing views. This is confirmation bias. The mind protects its beliefs, even when evidence changes. Markets punish rigid thinking. Another emotional trap is overreaction. Short-term news feels important. Small events feel large. Temporary problems feel permanent. Investors react instead of reflect. Great investors create distance between emotion and action. They slow down decisions. They use rules. They write plans. Rules protect against impulses. One simple rule is time. Waiting before acting reduces emotional intensity. Urgent decisions are often emotional decisions. Another rule is preparation. Knowing why you own something before trouble arrives. Writing down reasons. Writing down risks. Preparation creates calm during chaos. Emotional control does not mean ignoring feelings. It means not obeying them blindly. Fear is a signal. Greed is a signal. They deserve attention, not obedience. Long-term investors accept volatility. They expect discomfort. They plan for it. Short-term thinkers are surprised by volatility. Surprise creates panic. Emotions also affect consistency. People change strategies frequently. They abandon plans after short-term failure. Consistency is fragile under emotional pressure. Warren Buffett said that temperament matters more than intellect. This is a deep truth. Many intelligent people fail as investors. They cannot control themselves. Emotional discipline grows slowly. It is built through experience, through mistakes, through reflection. No one masters it quickly. The goal is progress, not perfection. Creating emotional discipline requires awareness, knowing personal triggers, knowing tolerance for loss, knowing limits. If losses cause panic, risk is too high. If gains create excitement and overconfidence, risk is creeping upward. Emotions are feedback. They show misalignment between strategy and personality. Investing should fit the investor. Another overlooked emotion is boredom. Boredom pushes people to act. They trade to feel engaged. This leads to unnecessary decisions. Boring investing often works best. Calm is an advantage. Most people underestimate it. When emotions are controlled, decisions improve. Patience increases. Clarity appears. But emotional control alone is not enough. Even calm investors can make another mistake. They can do too much. They believe action equals progress. They believe movement equals intelligence. This leads to constant buying and selling. Endless adjustments. That behavior leads to the next mistake: overtrading and doing too much. Chapter 7. Overtrading and doing too much. After investors learn emotional control, they often feel confident. They feel informed. They feel ready to act. This confidence can quietly turn into activity, and activity can turn into overtrading. Overtrading is not always obvious. It does not always look reckless. Sometimes it looks intelligent. It looks like constant improvement, small changes, frequent adjustments, regular buying and selling. Each decision feels justified. The problem is not one decision. The problem is the accumulation of decisions. Every trade carries cost: transaction cost, tax cost, emotional cost. These costs are small individually, but powerful together. Many investors believe more effort produces better results. This belief works in many areas of life. It fails in investing. In markets, doing more often means earning less. Jack Bogle warned investors clearly. He said that in investing, you get what you do not pay for. Frequent trading increases friction. Friction reduces returns. Another danger of overtrading is noise. Short-term price movement feels meaningful, but most of it is random. Reacting to noise creates mistakes. Markets move for reasons and for no reasons. Separating the two is difficult. Overtraders respond to everything: news, rumors, opinions. Long-term investors respond only to what matters. Overtrading also weakens conviction. If you sell quickly, you never allow ideas to mature. You never see compounding work. Compounding requires time and stillness. Constant activity interrupts growth. Another reason people overtrade is the illusion of control. Making decisions feels powerful. Holding feels passive. But holding is a decision, often the best one. Great investors understand this. They wait, they observe, they act rarely. Charlie Munger said that the big money is not in the buying or selling, it is in the waiting. Waiting is uncomfortable. It creates doubt. It creates boredom. Overtrading is often an attempt to escape boredom. Technology makes this worse. Trading is easy. Information is endless. Action is instant. Ease encourages excess. Overtrading also increases emotional swings. More trades create more wins and losses. More wins increase greed. More losses increase fear. This emotional volatility damages judgment. Another hidden problem is hindsight regret. After every trade, investors imagine better outcomes. If only I waited. If only I sold earlier. Regret feeds more trading. The cycle continues. Successful investing requires selective action, not constant motion. This means choosing fewer decisions, but making them thoughtfully. Long-term investors often hold investments for years, sometimes decades. They allow businesses to grow. They allow value to unfold. Overtraders interrupt this process. Another sign of overtrading is strategy hopping. Trying new approaches constantly. Abandoning plans too quickly. No strategy works all the time. Every approach has periods of underperformance. Impatience destroys good strategies. Consistency is rare and valuable. Overtrading also reduces learning. When trades are frequent, it is hard to identify what worked and why. Noise hides lessons. Doing less improves clarity. This does not mean ignoring change. It means responding only to meaningful change. Business fundamentals changing. Valuation becoming extreme. Risk increasing materially. Most daily movement does not qualify. Investing is a game of selection, not reaction. Another reason overtrading hurts is opportunity cost. Time spent trading is time not spent learning, not spent thinking, not spent improving understanding. Calm analysis produces better decisions than constant action. Markets reward patience quietly. They punish impatience loudly. Over time, investors who do less often outperform those who do more. This truth feels uncomfortable because it contradicts instinct. Effort feels virtuous. Stillness feels lazy. But markets are not moral systems. They are probability systems. Reducing unnecessary decisions improves odds. When investors learn to slow down, to trade less, to trust their process, they gain something valuable: time. Time allows compounding. Time allows learning. Time allows emotional stability. But even patient investors can fail. They can still miss something important. They can ignore what truly drives value: price, stories, trends. These can distract from fundamentals. That leads to the next mistake: ignoring business fundamentals. Chapter 8: Ignoring Business Fundamentals. After investors learn to slow down, after they trade less and wait more, they often feel disciplined. They feel patient. But patience without understanding is fragile. Many investors still focus on the surface. They watch prices. They follow charts. They listen to stories. They forget a simple truth. A stock is not just a price. It is a part of a real business. Behind every stock is a company, with employees, with customers, with costs, with decisions. Ignoring this reality is a costly mistake. Markets move every day. Businesses change slowly. Price moves fast. Value moves slowly. Investors who ignore fundamentals confuse motion with meaning. A rising price feels like success. A falling price feels like failure. But price alone says nothing about quality. A weak business can rise for a while. A strong business can fall temporarily. Only fundamentals reveal the truth. Business fundamentals are simple ideas. What does the company sell? Who are its customers? How does it make money? Are profits real and repeatable? Does cash actually flow in? These questions are boring to many people. They require reading. They require thinking. Stories are easier. Stories promise transformation. They promise disruption. They promise endless growth. Stories feel exciting. Markets love stories. But stories without fundamentals collapse eventually. Philip Fisher warned that many investors know the price of everything and the value of nothing. This mistake is timeless. Ignoring fundamentals also creates false confidence. When prices rise, investors assume everything is fine. They stop checking reality. Then problems appear suddenly. Revenue slows. Costs rise. Debt becomes heavy. Competition increases. By the time price reflects reality, damage is already done. Fundamentals act like early signals. They warn before price reacts. Cash flow is one of the most important signals. Profit on paper can be misleading. Cash reveals truth. A business that cannot generate cash is fragile. Another key fundamental is balance sheet strength. Debt can help growth. It can also destroy companies. Too much debt removes flexibility. It forces decisions at the worst time. Strong balance sheets create survival. Management quality matters deeply. Leaders allocate capital. They decide strategy. They shape culture. Poor management can ruin great businesses. Great management can rescue average ones. Ignoring management is ignoring the steering wheel. Competitive advantage is another foundation. Why customers choose this business. Why competitors struggle to copy it. Without advantage, profits attract competition. Competition destroys margins. No advantage means no long-term value. Some investors ignore these basics because they seem slow. They want faster answers. But slow thinking creates durable results. Another danger of ignoring fundamentals is emotional confusion. When prices move, investors do not know why. They react blindly. Understanding fundamentals creates confidence. Confidence creates patience. When you know why you own something, temporary declines are easier to endure. Without understanding, every decline feels threatening. Fundamentals also protect against overpaying. A great business can still be a bad investment at the wrong price. Price matters. Buying quality without considering price is careless. Buying cheap without considering quality is dangerous. Value lives at the intersection. Ignoring fundamentals often leads to chasing popular names, well-known brands, famous companies. Familiarity feels safe, but popularity often means high expectations. High expectations create fragile investments. When reality fails to match hope, prices fall hard. Understanding fundamentals reveals expectations hidden in price. Another mistake is focusing on metrics without context. Numbers alone do not explain a business. Growth without profitability. Profitability without sustainability. Context matters. Investing is not accounting. It is judgment. Judgment improves with understanding. Great investors read more than they trade. They study businesses deeply. They ask simple questions repeatedly. What could go wrong? What could change? What assumptions am I making? Ignoring fundamentals often comes from impatience. Learning takes time. Results feel distant. But markets reward those who do the work early. Fundamentals also help investors ignore noise. Daily headlines become less important. Short-term price movement loses power. Clarity increases. Over time, investors realize something important. Price is an opinion. Fundamentals are reality. Reality always wins eventually. When investors reconnect with fundamentals, they become calmer. They become selective. They stop chasing everything. But another mistake still waits. Even investors who understand businesses deeply can fall into a trap. They assume that what worked before will always work. They trust history too much. They believe past success guarantees future results. That belief leads directly to the next mistake. Believing past performance guarantees future results. Chapter 9. Believing past performance guarantees future results. After investors learn to study businesses deeply, after they focus on fundamentals and value, they often gain confidence. This confidence can quietly harden into belief. They believe that what worked before will keep working. Past success feels like proof. Charts show steady gains. Stories confirm strength. History looks reassuring. The mind loves patterns. It wants continuity. It wants predictability. Markets rarely provide it. Past performance is easy to see. Future performance is not. This gap creates one of the most common investing mistakes. People assume yesterday explains tomorrow. A company that grew strongly in the past feels safe. An asset that delivered high returns feels reliable. But markets are not mirrors. They are moving systems. George Soros said that markets are always in a state of uncertainty and flux. This truth never changes. Every period has unique conditions. Interest rates change. Technology evolves. Consumer behavior shifts. Competition intensifies. Success attracts challengers. High returns invite attention. Attention brings competition. Competition compresses margins. This is how strong performance plants the seeds of weaker performance. Investors often forget this cycle. They buy after success is visible, when expectations are high, when prices already reflect optimism. The future, then, has little room for surprise. When results are merely good instead of amazing, prices fall, not because the business failed, but because expectations were unrealistic. Another danger of relying on past performance is complacency. Investors stop monitoring change. They assume strength will continue automatically. They miss early warning signs, new competitors, shifting customer preferences, rising costs. By the time reality becomes obvious, value has already declined. History is full of examples. Once dominant companies that lost relevance, industries that peaked and faded. Nothing stays on top forever. This does not mean avoiding successful businesses. It means avoiding blind faith. Great investors respect history, but they do not worship it. They ask forward-looking questions. What must go right for this success to continue? What could disrupt it? What assumptions am I making? Past performance can inform. It cannot guarantee. Another mistake is performance chasing. Investors move money toward what recently worked best. They abandon what struggled. This behavior feels logical. It feels safe. It is often harmful. Buying what performed well usually means buying at high prices. Selling what performed poorly often means selling low. This reverses the basic principle of intelligent investing. Long-term returns often come from patience during underperformance, not from chasing recent winners. Performance cycles rotate. What leads one period often lags the next. Investors who chase performance arrive late. Another subtle problem is narrative reinforcement. Success creates stories. Stories justify belief. Media celebrates winners. Experts explain why success was inevitable. These explanations arrive after the fact. They create illusion of predictability. The human mind prefers simple stories. Markets operate on complex forces. Confusing explanation with prediction is dangerous. Understanding why something succeeded does not mean it will continue to succeed. Conditions change. Another trap is anchoring. Investors anchor to past prices. They remember where a stock used to trade. They believe it will return there. Price memory has no meaning to markets. Only future cash flows matter. Anchoring creates false hope. Hope delays decisions. Delaying necessary decisions increases loss. Wise investors separate analysis from memory. They evaluate investments as if seeing them for the first time. They ask, would I buy this today at this price? If the answer is no, holding requires reconsideration. Another issue is survivor bias. We remember winners. We forget failures. For every success story, many failures disappeared quietly. History books focus on survivors. This creates unrealistic expectations. Investing success looks easier than it is. The lesson is humility. No trend lasts forever. No company is immune to change. No strategy works in all environments. Adaptation matters. Investors who survive long-term are flexible. They update beliefs. They respond to new information. They do not cling to the past. This does not mean constant change. It means thoughtful adjustment. Markets reward those who learn continuously. Believing past performance guarantees future results removes curiosity. It closes the mind. Closed minds miss change. Open minds survive it. Once investors accept this truth, they often seek guidance. They look for opinions. They follow experts. They consume more information. This creates another problem. Too much information. Too much noise. That leads directly to the next mistake. Listening to too much noise. Chapter 10. Listening to too much noise. After investors stop trusting past performance blindly, they often search for reassurance. They want guidance. They want confirmation. So they listen. They listen to news. They listen to experts. They listen to opinions. They listen to predictions. At first, this feels responsible. Staying informed sounds intelligent. But information slowly turns into noise. Noise is information without usefulness. It is constant. It is loud. It demands attention. Modern markets are built on noise. News updates arrive every minute. Headlines compete for emotion. Fear spreads fast. Excitement spreads faster. Most of this information has no long-term value. But the brain treats all information as important. This creates confusion. Investors feel overwhelmed. They feel uncertain. They feel pressure to act. Noise creates urgency. Urgency creates mistakes. Warren Buffett said that the stock market transfers money from the impatient to the patient. Noise feeds impatience. Most news focuses on short-term movement, daily price changes, economic data points, political statements. These things matter to traders. They rarely matter to long-term investors, but constant exposure makes them feel important. The problem is not information itself. The problem is volume. Too much information reduces clarity. Investors begin to react instead of think. Another danger of noise is authority bias. When experts speak confidently, people assume accuracy. Experts are often wrong. Predictions sound precise. They feel comforting. But the future remains uncertain. No expert can consistently forecast markets, yet opinions are delivered with confidence. Confidence sells. Accuracy does not. Media rewards bold statements, not cautious truth. This encourages extreme views. Extreme views distort judgment. Noise also creates emotional cycles. Good news creates excitement. Bad news creates fear. Emotional swings weaken discipline. Long-term investors require emotional stability. Noise destroys it. Another problem is contradiction. One expert says buy, another says sell. Both sound convincing. Conflicting information paralyzes decision-making. Investors delay action, or act impulsively. Neither helps. Noise also reinforces short-term thinking. Daily updates encourage daily decisions. But investing outcomes unfold over years. Daily focus misaligns behavior with goals. Great investors reduce exposure to noise deliberately. They choose what to ignore. Ignoring is a skill. They read selectively. They focus on fundamentals. They avoid constant updates. They know that missing most news does not harm results. It often improves them. Noise also creates social pressure. When everyone talks about markets, doing nothing feels wrong. Silence feels irresponsible. But silence is often where clarity lives. Another hidden danger of noise is false learning. People feel informed, but understanding does not increase. Knowing headlines is not knowing businesses. Knowledge depth matters more than knowledge volume. Noise encourages shallow thinking. Depth requires quiet. Noise also feeds anxiety. Anxious investors make poor decisions. Stress narrows perspective. It shortens time horizons. Short horizons create mistakes. Long-term success requires calm. Calm requires boundaries. Great investors create information diets. They limit intake. They prioritize quality over quantity. They read reports, not headlines. They study businesses, not opinions. They observe trends slowly. They do not react to every signal. Another issue is personalization of news. Algorithms show what triggers emotion. Fear and anger spread fastest. This increases volatility in perception. Markets feel more dangerous than they are. Perception drives behavior. Behavior drives results. Controlling perception matters. Noise also distracts from personal goals. Investors forget why they are investing. Long-term security, freedom, stability. Daily noise shifts focus to short-term gain. Purpose fades. Without purpose, discipline weakens. Noise is addictive. It feels productive. It feels responsible. Breaking away feels uncomfortable. But comfort is not the goal. Clarity is. Long-term investors learn to step back. They review portfolios occasionally. They avoid constant monitoring. Less checking reduces emotional response. This improves decisions. When investors stop listening to noise, they regain control. They think clearly. They focus on what matters. But clarity alone is not enough. Even calm, informed investors can fail. They may still lack direction. They react well, but they react without a plan. Without a plan, even good decisions become inconsistent. That leads directly to the next mistake: failing to have a clear plan. Chapter 11. Failing to have a clear plan. After investors learn to ignore noise, after they calm emotions and slow down, they often believe they are finally prepared. But preparation without direction is incomplete. Many investors act without a clear plan. They react intelligently. They think rationally, but they do not know where they are going. Without direction, every decision feels uncertain. A plan is not about prediction. It is about intention. Most people think a plan means knowing the future. That is not true. A plan defines behavior, not outcomes. Without a plan, investors drift. They buy because something looks attractive. They sell because something feels uncomfortable. Each decision may seem reasonable, but together they lack coherence. This creates inconsistency. Inconsistent behavior produces inconsistent results. A clear plan answers simple questions. Why am I investing? What is my time horizon? How much risk can I tolerate? What will I do when markets fall? Most investors never answer these questions clearly. So when trouble arrives, they improvise. Improvisation under pressure leads to mistakes. Dwight Eisenhower once said that plans are useless, but planning is indispensable. This idea fits investing perfectly. The future will not follow your plan exactly, but the act of planning prepares the mind. A plan creates reference points. It gives you something to return to during chaos. Without it, fear takes control. Another danger of having no plan is copying others. When unsure people look outward, they follow opinions. They imitate behavior. This brings the investor back to the crowd. A plan creates independence. Another mistake is having vague goals. People say they want wealth, they want freedom. But vague goals produce vague decisions. Clear goals create clear trade-offs. Short-term needs differ from long-term goals. Income needs differ from growth goals. Without clarity, investors mix strategies. They expect long-term growth, but react like short-term traders. This internal conflict creates stress. A plan aligns behavior with goals. Another overlooked aspect of planning is rules. Rules protect against emotion. For example, under what conditions will I sell? Under what conditions will I buy more? Without rules, every decision becomes emotional. Rules do not remove judgment. They guide it. Another planning mistake is rigidity. Some investors create plans that cannot adapt. Markets change. Life changes. A good plan is flexible. It evolves without losing its core principles. Flexibility allows survival. Another issue is forgetting the plan during success. When things go well, discipline feels unnecessary. Confidence grows. People break rules because they feel safe. This is often when damage begins. Plans matter most when emotions are strong. A written plan is powerful. Writing slows thinking. It clarifies intention. Many investors keep plans in their heads. Under stress, memory changes. Writing creates commitment. Another benefit of a plan is measurement. You can evaluate decisions against intention. Without a plan, you only see outcomes. Outcomes alone are misleading. Good decisions can have bad results. Bad decisions can have lucky results. A plan helps separate process from outcome. This improves learning. Another mistake is copying someone else's plan. What works for one person may not work for another. Risk tolerance differs. Time horizon differs. Personality differs. A plan must fit the investor. Discomfort is a signal. If a plan causes constant anxiety, it is not aligned. Adjusting the plan is wiser than abandoning investing. A clear plan also reduces overtrading. It limits unnecessary decisions. It tells you when to act and when to wait. Waiting becomes intentional, not lazy. Intentional waiting builds confidence. Another benefit is resilience. During market declines, a plan provides stability. Instead of asking what is happening, you ask what should I do according to my plan. This shift is powerful. It replaces fear with structure. Many investors underestimate this. They believe intelligence alone is enough. But investing is not a test of intelligence. It is a test of consistency. Consistency requires structure. Structure comes from planning. A plan does not need to be complex. Simple plans often work best. Complexity increases fragility. The goal is not perfection. It is alignment. When investors finally create a clear plan, they feel grounded, they feel steady. They stop reacting to every movement. But even with a plan, even with discipline, even with patience, another challenge remains: time. Many investors do everything right, but they stop too soon. They lose faith. They quit. That mistake is often the most painful. Giving up too early. Chapter 12. Giving up too early. After investors build a plan, after they control emotions, after they ignore noise and focus on fundamentals, they expect results. When results take time, doubt appears. Giving up too early is one of the most painful mistakes in investing, because it often happens just before success begins. Investing rewards patience unevenly. Progress is not smooth. Returns do not arrive in straight lines. There are long periods of waiting. Periods where nothing seems to work. Periods where effort feels wasted. This is where many investors quit. They believe something is wrong. They believe they are doing it wrong. But often nothing is wrong at all. Compounding works quietly. It is invisible in the early years. Small gains look insignificant. Progress feels slow. Then time passes. Growth accelerates. But most people leave before this phase begins. Albert Einstein reportedly called compound interest the most powerful force in the universe. Powerful forces often act slowly at first. Giving up early destroys compounding. It resets progress to zero. Another reason people quit is comparison. They see others succeed faster. They hear stories of quick wins. They feel left behind. Comparison creates impatience. Every investing journey is different. Timing differs. Starting points differ. Opportunities differ. Comparing journeys creates frustration. Another cause of quitting is short-term loss. Loss feels personal. It feels like failure. Many investors confuse temporary loss with permanent failure. Markets fluctuate. Volatility is normal. Those who expect smooth progress are unprepared for reality. Long-term success requires endurance. Endurance is not exciting. It is quiet. It is steady. Giving up often comes after a string of disappointments. One mistake, then another. Confidence erodes. People begin to question everything. This emotional exhaustion leads to quitting. The irony is painful. Mistakes often teach the most valuable lessons, but only if the investor stays long enough to apply them. Those who quit never benefit from learning. Another reason people quit is changing strategies too often. They never give one approach enough time. Every strategy has weak periods. Quitting during weakness guarantees failure. Consistency matters more than brilliance. Warren Buffett often emphasized the importance of staying the course. This simple advice is difficult to follow. Staying the course feels passive. Quitting feels like action. Action feels relieving in moments of stress, but relief is temporary. Regret lasts longer. Another factor is unrealistic expectations. People expect investing to solve everything quickly. When reality moves slowly, disappointment grows. Investing is not a shortcut. It is a process. Understanding this reduces frustration. Giving up early also happens when investors forget their purpose. They lose sight of why they started. Freedom, security, peace of mind. Short-term discomfort distracts from long-term goals. Reconnecting with purpose renews patience. Another challenge is boredom. Long-term investing is often boring. Boredom makes people seek change. Change feels exciting. But excitement often leads to mistakes. Boring investing is usually effective investing. Endurance also requires trust. Trust in the process. Trust in time. Trust grows slowly. It grows through experience, through surviving downturns, through seeing recovery. The first major decline is terrifying. The second is uncomfortable. The third becomes familiar. Experience builds resilience. Those who quit never build this resilience. Another reason people quit is lack of progress measurement. They look only at short-term results. They ignore long-term improvement. Tracking behavior rather than outcomes helps. Are you saving consistently? Are you avoiding major mistakes? Are you staying disciplined? These matter more than short-term returns. Giving up early often comes from perfectionism. People expect flawless execution. Mistakes feel unacceptable, but mistakes are inevitable. Progress comes from persistence, not perfection. Every successful investor has failed many times. They simply did not stop. The market rewards those who endure uncertainty. Endurance is a competitive advantage. Most people cannot wait. Most people cannot stay calm. Those who can gain an edge without being smarter. Time favors patience. Giving up early is understandable, but it is optional. The decision to continue is a choice. Choosing to stay does not mean ignoring reality. It means adjusting without abandoning. It means learning without quitting. Long-term investing is not about being right quickly. It is about being reasonable for a long time. Those who stay long enough experience a shift. Doubt fades. Confidence grows. Not confidence in prediction, confidence in process. This confidence is quiet. It does not need validation. It comes from surviving storms. When investors reach this stage, they realize something important. Success was not about avoiding mistakes. It was about avoiding the biggest ones. And the biggest mistake of all was giving up too early.